Hello everyone. Today we discuss about financial accounting. So bookkeeping and accounting. Bookkeeping is the systematic recording and is the part of accounting that records transactions and business events in the form of journal entries in the accounting system. Accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money the transactions and the events which are in part at least of a financial character and interpreting the results thereof. Bookkeeping and accounting are often heard being used interchangeably. However, accounting is the overall practice of managing finances of a business or individual, while bookkeeping refers more specifically to the tasks and practices involved in recording the financial activities. Bookkeeping system. There are two types of bookkeeping, that is single entry and double entry system of bookkeeping. Single entry system of bookkeeping. Under this system, both debit and credit aspects of transaction are not recorded. Only personal accounts and cash book are opened. Under this system, balance sheet is not prepared. It is improper system of bookkeeping. Now double entry system of bookkeeping. The double entry system of bookkeeping is based on the fact that every transaction has two aspects, which therefore affects two ledger accounts. Every transaction involves a debit entry in one account and a credit entry in another account. Each and every debit aspects has its equal and corresponding credit aspect and vice versa. Based on practical of principle of dual aspect of each transaction, for correct representation both of them should be recorded. Requires maintenance of records of assets, liabilities, revenues and expenditure. Impact of each transaction can be seen on measured. Total assets are equal to total equities or uh, equities. Accounts often use T accounts to visualize the debit and credit effects on the account's balance. The debit on account means to enter an amount on the left side of the account. To credit an account means to enter an amount on the right side of an account. Now, classification of accounts. Concept of debit and credit golden rules. First, personal account and impersonal account. Personal account, that is debit, the receiver, credit, the giver, and impersonal account, real account and nominal account. That is debit what comes in, credit what goes out, and nominal account, debit all expenses and losses, credit all incomes and gains. Now we discuss about personal account. Personal accounts are accounts relating to persons or organization which whom the business has transactions. That is customer, supplier, money, lenders, etc. Real accounts. Real accounts refer to accounts in which properly or property and possessions are recorded. That is land, building, plant and machinery, vehicles, cash, bank, etc. And nominal accounts are revenue, expenses, gains and losses. and wages, salary, discount, etc. Now, accounting concepts and conventions. These generally accepted accounting principles lay down accepted assumptions and guidelines and are commonly referred to as accounting concepts. Accounting concepts: first, business entity; second, money measurement; third, going concern; fourth, cost concept; fifth, objectivity; sixth, accruals or matching; seven, realizations; eight, periodicity; and nine, dual aspects. Then accounting conventions: uh, accounting for conservation or conservatism; consistency; accounting for full disclosure; and materiality. Now, first, accounting concepts. Business entity: the business and its owner or owners are two separate existence entity. Any private and personal income and expenses of a owner or owners should not be treated as the income and expenses of the business. Economic entity: company keeps its activity separate from its owners and other businesses. Example: insurance premiums for the owner's house should be excluded from the expense of the business. Second, money measurement: all transactions of a business are recorded in terms of money and it provides on a common unit of measurement. Example: market conditions, technological changes, and the efficiency of management would not be disclosed in the accounts. Number 3, going concern concept. The business will continue in operational existence for the foreseeable future. Financial statements should be prepared on a going concern basis unless management either intends to liquidate the enterprise or to cease trading or has no realistic alternative but to do so. Example: possible losses from the closure of business will not be anticipated in the accounts. Now, accounting concepts. Cost concept: assets should be shown on the balance sheet at the cost of the purchase instead of current value. Example: the cost of fixed asset is recorded at the date of acquisition cost. The acquisition cost includes all expenditure made to prepare the asset for its intended use. It included the invoice price of the assets, freight charges, insurance, or installation cost. Now, objectivity. The accounting information should be free from bias and capable of independent verifications. The information should be based upon variable evidence such as invoices or contracts. Example: the recognitions of revenue should be based on variable or verifiable evidence such as the delivery of goods or the issue of invoices. Now, accrual or matching. Revenues are recognized when they are earned, but not when cash is received. expenses are recognized as they are incurred but not when cash is paid. The net income for the period is determined by subtracting expenses incurred from revenues earned, and matching efforts or expenses should be matched with accomplishment, that is revenues, whenever it is responsible and practicable to do so. Example, expenses incurred but not yet paid in current period should be treated as accrual or accrued expenses under current liabilities. Now, accounting concept. The realization concept. This concept holds to the view that profit can only be taken into account when realization has occurred. Generally, sales revenue arising from the sale of goods is recognized when the goods are delivered to the customers. Revenue recognitions generally occurs when realized or realization or realizable and when earned. Example, profit is earned when goods or services are provided to customer. Thus, it is incorrect to record profit when order is received or when the customer pays for the goods. Now, periodicity. The life of an entity is divided into short economic time period on which reporting statements are fashioned. Periodicity. Company can divide its economic activities into time periods. Example, based on this assumption, assets are classified into current and fixed assets. Current assets have benefits within 12 months period and fixed assets have benefits beyond 12 months. Dual aspect transaction has two-fold effect, debit and credit. Each and every debit aspect has equal and corresponding credit aspect and vice versa. Accounting equation, asset equal to capital plus liability. Now, accounting conventions. Materiality. Financial statement should separately disclose significant items, for they would influence decisions of users. Accounting does not serve a useful purpose if the effort of recording a transaction in a certain way is not worthwhile. In other words, do not waste your time in the elaborate recording of trivial items. A stock of stationery worth rupees 10 should be treated as an expense when it was bought. Now, accounting for conservatism. The accountant should always be on the side of safety. The prudence concept means that normally he or she will take the figure which will understate rather than overstate the profit. Provision is made for all known liabilities, and conservatism means anticipate the expected future losses. Now, provision for doubtful debts should be deducted from debtors in balance sheet. Now, accounting convention, consistency. When a firm has once fixed a method for the accounting treatment of an item, it will enter all similar items that follow in exactly the same way. And frequent changes in the accounting methods would lead to misleading profits calculated from the accounting records. And depreciation method of certain fixed assets once adopted should be used in the following years. Now, disclosure. The financial statements of a firm must include all information necessarily for the information of valid decisions by the user. Any information that might be relevant to an investor or creditor should be disclosed either in the body of the financial statements or in the notes attached thereto. Method of issue of stock, that is FIFO, LIFO, weighted average method of depreciation, SLM, WDV methods of valuation of goodwill, etc. Journal. Journal is a primary set of books in which daily business transactions are to be recorded. According to Kruper, a journal is a book employed to classify or sort out transactions in a form of convenient for their subsequent entry in the ledger. Necessity of journal: convenient recording of transaction, maintaining and preserving the identity of transaction, ascertaining the true nature of transaction, and maintaining permanent record of transaction. Now, functions of journal: to analyze each transaction into debit and credit so as to enable their posting in the ledger, to arrange transaction chronological, that is, in order to date. Journal advantages of journal: show all necessary information relating to a transaction, provide the explanation of the transaction, date-wise record of all the transactions can be obtained, help in locating and preventing the errors. Now, limitations of journal: recording all the transactions in a journal requires writing down name and account involved, individual posting of each accounts debited and credited, does not provide information on prompt basis, does not facilitate the internal check system since the journal can be handled only by one person. Journal become bulky and voluminous. Journal problems. So there are different types of journal problems. Entry problem, policy covering, etc. And now, ledger account. General ledger accounts are used to post the economic activities. Posting is the name of transferring accounts from the book of prime entry through related ledger accounts. When all the transactions for a given period have been journalized, the next step is to classify them according to the account affected. Ledger is a book of account that keeps separate record for each account. Ledger is the book of secondary entry. An account in its simplest form is a T-shape. It should be noted that journal contains a chronological record while ledger contains a classified record of all economic activities. general ledger posting and balancing process. The debit part of journal entry is recorded on the debit side of the relevant account by credit account name source. The credit part of the journal entry is recorded on the credit side of the relevant account by debit account name. In the reference column of the general journal, the code or page number of ledger account are noted. In the reference column of the ledger account, the page number of the journal is noted. Find the total of debit side and find the total of credit side. Put bigger value both sides in total. Calculate the difference between two sides. This is the balance, the balancing figure between the two sides. Write the balance on the smaller side with keywords, that is balance CD. However, the balance will be known by the larger side, that is, if the debit side is greater than the credit side, the balance will be known as debit balance and vice versa. Bring down the debit balance on the debit side, writing the words in description column, that is balance BD. Similarly, bring down the credit balance on the credit side by writing the words in the description column balance BD. And so that's the descriptions of the accounting for managers. On the other side, the final accounts, popularly the trading and profit and loss account and the balance sheet, are together called the final account. The trading and profit and loss account is prepared to show the final results of a business, maybe in the form of profit or loss during an accounting period of year. Balance sheet is prepared to show the financial positions or conditions of business in terms of position of assets and liabilities of a business as on a particular date. Trading account. Trading means buying and selling. The trading account shows the result of buying and selling of goods. End results of trading account is gross profit or gross loss. Profit and loss account. After calculating the gross profit or gross loss, the next step is to prepare the profit and loss account. To earn net profit, a trader has to incur many expenses apart from those spent for purchases and manufacturing of goods. If such expenses are less than gross profit, the results will be net profit. When total of all these expenses are more than gross profit, the result will be net loss. Now balance sheet. Balance sheet is prepared by taking up all personal accounts and real accounts, assets and properties together with the net results obtained from profit and loss account. On the left hand side of the statement, the liabilities and capital are shown. On the right hand side, all the assets are shown. Balance sheet is not an account, but it is statement prepared from the ledger balances, and balance sheet is defined as a statement which sets out the assets and liabilities of a business firm and which serves to ascertain the financial position of the same on any particular date. And meaning and need of adjustment entries. Transactions omitted relate to the current year must be entered in book. If a transaction entered is not related to the current year fully or partly, that portions of income or expense must be excluded. This process is made through adjustment entries in the books of accounts. If we ignore to make the necessary adjustment, the trading profit and loss accounts do not show the true profit or loss, and in consequence balance sheet fails to depict true financial position of the business. This situation defeats the very purpose of final accounts. Hence, adjustment entries play an important role in presenting correct picture of accounts. And accounting treatment, trading and profit and loss and balance sheet together are called as final account. Item prepared in the trial balance prepared only once in final accounts, either on the debit or credit. Any adjustment entry requires two positions, debit and credit, for the same amount. Important point is student should do the posting debit and credit in the concerned account simultaneously. So that's all the video, my friends. If you like my videos, please subscribe my channel. Thanks again for watching my videos. Have a good day.